Hey everyone, Eddie Wilson here with the Think Realty video podcast. As you can see, I'm not Avi Golhar. Avi usually is the host here, but every once in a while they let me in the studio and let me do my thing, and I enjoy that and enjoy getting to interview some great people around the country. I typically save the best for me. I give Avi everyone else. No, I'm just kidding. But I do enjoy doing this periodically, once a quarter or every 6 months or so. But we've got a great guest today that I'm really excited about, and I'll introduce him to you in just a second. But first of all, let me say thank you to our podcast sponsor, which is Real Property Management, the largest residential property management franchise in North America. They manage tens of thousands of properties for individuals, investors, and institutions throughout the country. And you can learn more about that at realpropertymanagement.com. That's realpropertymanagement.com. Their phone number is also 888-806-7088. That's 888-806-7088. Make sure you go check them out, visit them. If you're in need of a property manager, they're a great one that you can go and reach out to. And thank them also for making the show possible and supporting the show here. We are excited to have the guest, to announce the guest that's on with us today. It's somebody that you are going to be enriched by listening to him and his experience in the industry. Our guest today is Paul Jackson with Residential Capital Partners, and they provide a great service for real estate investors. Let's go ahead and welcome him on, and we'll get started with the interview. Paul, it's great to have you with us today. Thank you so much for joining us.
Thanks for being here. Thanks for having me.
Yeah, absolutely. And we are excited to have you. Obviously, our kind of philosophy at Think Realty is you need two things to make real estate investing profitable and doable. That is, you need deals and you need money. And so obviously, you got one of these things taken care of, and so we can get talking about that here shortly. But talk to us, just give us 30,000-foot view on Residential Capital Partners and tell us, what your model is and what it is you're trying to do in this industry.
Well, Residential Capital Partners was founded in 2009. We had a commercial real estate investment firm that had a number of projects underway leading into the global financial crash. And as we like to say, every commercial real estate investor turned into a debt buyer during the global financial crisis. And so part of our journey through that global financial crisis was looking at a lot of distressed debt that the banks were selling off. As the banks were taking on TARP money and selling off bad assets, we were looking at a lot of first mortgages and second mortgages. And in our underwriting of those pools of mortgages, we touched base with and got to know a lot of the real estate investors in the single family market. And as an outgrowth of those debt buying efforts, we began hard money lending to a lot of the folks we were talking to during that period that said there was a credit crunch in the single family real estate lending space. And so we filled that void beginning in 2009 with both a hard money lending product and what we termed at the time was a rehab to rental product, because most of the investors that we were speaking with were telling us that they didn't want to take the short-term money without some way of securing the property for the long term, because the market was not healthy yet. And so the flip side of the fix and flip market didn't exist at that time. It's now back to full health, it seems, in most markets that we're lending in. So we had a rehab to rental, which was a 3-year rental product that once the house was fully rehabbed, they could roll it in with the tenant in place into a 3-year rental mini perm loan. So we launched that in 2009. We've been growing it ever since. We are excited to say that we just launched a long-term rental product about 60 days ago, as well as we still have our rehab to rental product that's now no longer a 3-year loan, but a 12-month sort of rental bridge loan. Once an investor has fixed up a house, has it ready to be tenanted, then we will put that onto a 12-month rental bridge note so that they have options in time to go explore the most efficient ways they can finance that rental home long term.
That's awesome. So you've obviously now kind of created a seamless product so that they can, rehab that property and then put it into their portfolio, and then you're lending on it. What states are you lending in? Is it primarily Texas? Are you lending outside of Texas? And then is all of those products in the states? What states are you lending with those products?
Sure. We're based in Texas, based in Dallas, Texas, but we're loaning nationwide except for Arizona and Nevada.
Okay.
And all of our products are available across the spectrum of the country and across the product types.
Awesome. And so that long term, what's that? I've got a lot of investor friends. I'm a heavy real estate investor myself.
Sure.
There's a lot of interest, in these long-term products. What are the terms? What are the qualifications? Who qualifies for a loan like that?
Sure. Well, on the hard money side, the easiest way to say it is our minimum credit score is a 620.
Sure.
We've worked really hard over the years to have standard rates. So on a 9-month loan, it's a 10% interest rate with 3 points that can be deferred to the back.
Okay.
We like to say our interests are aligned with our borrowers. So we don't ask you to pay points until you're realizing a profit.
Sure.
And so that's a hallmark of our business model. And then on the rental side, if the home is fully rehabbed and there's a tenant in place, then the credit might be a little bit more flexible in terms of the minimum credit score. But everything scales from the credit at that point and the leverage at that point, the loan to value. So it's a little bit more complicated just because we have to tweak the interest rates up and the leverage down based on the investor's situation.
Sure. What's kind of the sweet spot on loan to value and interest on those long term? I mean, what's a maybe middle of the road type scenario?
Middle of the road on a rate and term refinance for a property that maybe you've rehabbed, you've got a tenant in place for more than 90 days. Our rates start at 6% and we'll go up to 85% loan to value on that product. And then on a cash out refinance that you've owned a property for more than 180 days, our loan to value will go up to 80% of the home's value.
Okay. Yeah, that's a great product. Are you seeing any parts of the country really come alive to a product like that? Investors that have invested heavy that are now trying to either cash out or leverage what they currently have so they can build a deeper portfolio. Are you seeing any areas of the country really come to life because of a product like that?
No particular area, but we are hearing that feedback from a lot of different investors that have either worked hard to develop a portfolio that they now have significant equity in, and so they're trying to monetize that portfolio to give them the opportunity to go do more business in their market. Certain markets, obviously, Dallas, Texas is a little hotter in terms of the price points that investors are continuing to push the envelope. We're doing a lot of business along the eastern seaboard from Boston to Florida and across the southeast, and seeing some uptick in the northwest as well. But generally speaking, from a new investor to an experienced investor, we're seeing interest across the board. Some investors are using our bridge money to park 5 to 10 properties while they work to take them to Fannie or Freddie and do a much more efficient financing on a long term. Some of our investors have maxed out with Fannie and Freddie, and so they're looking for alternative financing. And then some of our investors might have existing investors or partners in their portfolios that they want to take out, and so they're utilizing the cash out refinance option.
That makes a lot of sense. I mean, obviously, it seems like you're pretty flexible to whatever the investor need is.
We try to be. We try to be flexible. On the hard money side, we're a balance sheet lender, so we're been very flexible for 10 years, offering 100% financing on up to 70% of ARV, including the purchase and the rehab, with the points deferred to the back. So we feel like that's
nice.
Us putting a flexible foot forward on the short-term money.
Sure.
On the long-term money, we've got some other capital partners that we have to make happy. And so it gets a little less flexible, but we still have worked hard to maintain that flexibility.
Sure. Yeah, that's great. I think, it sounds like the big differentiator of you and maybe a lot of other lenders that are out there is that flexibility and that ability to look at each situation uniquely, being a balance sheet lender, and making decisions that aren't just inside of this underwriting criterion box. I mean, obviously you have your limitations, but it sounds like you're pretty flexible and really are trying to service that real estate investor. That's pretty accurate?
That's right. Absolutely.
Awesome. Any other differentiators? I mean, anything else that you'd kind of tout as something that differentiates you from the average lender?
No money down, fix and flip funding is kind of our tag phrase, and we feel like our best foot forward to give our borrowers liquidity during their investment period, give them peace of mind during their investment period, and then on the longer term rental side, we have two products that we just feel like give borrowers their best opportunity to park a property while they look for the best financing, or utilize our long-term financing if it works for them. Yeah. Aside from that, customer service and history in the business for the last 10 years, we feel like it's been fun to watch the industry grow, and we think it's got another 10 to 20 years ahead of it.
Yeah, that's awesome. So, I mean, obviously, lending aside, you guys are seeing lots of movement in the national marketplace. You guys are lending all over the country. What are you seeing? I mean, there's so much. I just interviewed Doug Duncan, the chief economist for Fannie Mae, and there's all this conjecture about sentiment and where people are today and job security. And I mean, like, what are your thoughts on the economy today? I mean, like, where are you at? Are you guys kind of in this position where you're cautiously watching the market for a downturn? Are you guys all in with expectation of a long run? I mean, like, what do you guys see from an economic standpoint?
Economically speaking, I'd say three things. Number one, rates dropping has created a run on the refinancing of single-family houses to the point that we've been, phones off the hook talking to appraisers, trying to get them to not push out the appraisal process 2 weeks. The appraisers that we speak to on a national basis have really seen a run on refinances, which has created stress in our marketplace for investors that are trying to get deals done on a quick time frame. Two, I would say, nationally speaking, we have pulled in the reins a little bit on the repair side of things, where we might have been extending out a little bit more line on the repair side of the purchase and repair budget. We're trying to bring that in a little bit because we've seen investors that are trying to stretch for that next deal, and that's caused them to push their purchase price, and which in some cases has also meant that they've also had to add more repairs to the budget to make the property on the backside more marketable. Sure. And so we're really looking closely at repairs, and we always want to make sure that the repairs are sufficient enough to get the house ready for resale or for a tenant to be in there. But I would say those are two things that we have seen in the most recent weeks. And then long term, to your question about where we see the market, I think our analysis is similar to other lenders, looking at the largest generation of baby boomers and their retirement plans, with the influx of millennials coming into either an affordable home that's in a $250,000 ballpark, or a rental home as they leave the urban areas and move more to that kind of first loop suburban market where they may want to start a family, have a swing in the backyard instead of living in a high-rise apartment. I think that gives us comfort long term. Even if we see a correction in the near term, long term we feel like this is a great opportunity.
Yeah, I couldn't agree with you more. And I have that. I mean, as an investor myself, I have the same sentiment. I mean, I think obviously the statistics show that the baby boomers haven't really started to exit their houses in masses yet, but it has to come. I mean, like, there's an obvious amount of inventory coming on the market within the next 5 to 7 years. which a lot of the houses that the older generation are holding on to are perfect starter homes after a rehab process. And so, hopefully it's the nice convergence of the baby boomers exiting their homes that they still have, and the millennials, ramping up their buying, and then hopefully you and I, as investors and people servicing investors, are right in the center of that amazing convergence over the next 5 to 7 years. So I'm with you. I think, there may be, we might be falling back into a traditional market cycles where we decrease 3-4% or whatever. But, in the end, there's too much inventory coming on the market, and there are too many buyers that, or renters, however they fall, the millennials fall into that place, that there has to be opportunity, because there's two very amazing opportunities coming, within the next 5 to 10 years. So, yeah, I feel the exact same way, and I think I share the same sentiment. Well, that's awesome. How do they get a hold of you? We're coming up on time, but how do they reach out to you guys? What's the best way to reach out? Are you guys on social? What's the easiest way for them to get involved in you and get you involved in their deals?
The easiest way is to go to www.residentialcapitalpartners.com and click apply now, or scroll down to contact and give us a call. But apply now on our website is the best way to get a hold of us. We do have a social media on LinkedIn and Facebook presence, but I would say our website's the best way to get a hold of us. And we encourage everybody to go ahead and apply for credit as a start, so that we can get them enrolled and tell them what their pre-qualification commitment is from Residential Capital Partners, with the hope that we truly are giving you the peace of mind. Now you've got your fishing license, now go find a fish, and let's carve it up together once you found it.
That's awesome. I think a lot of our viewers have found capital over the past year or two, because they've gotten heavy into the investing game. And most of them get a little bit lazy and just kind of let it run its course. Once you find the capital, it's like, that's the place I'm going to, And so I would encourage anybody that's watching today to at least, engage these guys. I mean, go to residential, to Residential Capital Partners and see what they can offer. I mean, if you just take what he said from this 0% down and moving, that deferred points that you're deferring to the back end of the loan, for an investor, that is far more valuable than getting a percent of interest cheaper on the loan, because it allows me to be more fluid in my investment. And so, for the listener and for the viewer, make sure you guys go on there and take advantage of this. Sounds like a great program with a great company that's been around for over 10 years now. So I really appreciate your time, Paul. Thank you so much for joining us. Anything else you want to say before we close?
No, I just say the last thing I'll say is what we always tell our investors. We know a lot of investors are out there. They find a great property. They might have capital, like you say, but they have the ability to sell the contracts. And so one of the things we encourage everybody to do, apply now, have the capital ready to go. And just by closing on that property instead of assigning the contract, closing on the property, cleaning out the property, you can wholesale that property for a premium above what you would sell the contract, and we can be your partner to do that. And so that's maybe our parting word of wisdom.
I love it.
Tip for the day.
So many wholesalers, if they would just get into this quick flip model, do exactly what you said, because they've got the capital lined up, could make another 10, 15, 20% on the same deal that they're letting somebody else make the money on. So love it. Great wisdom. And thank you so much for your time today. I appreciate the wisdom coming on, and thank you guys for the service to the industry that you provide.
Thank you. Appreciate it.
Yep, absolutely. Think Realty Nation, thank you so much for watching today and listening, downloading this podcast. This segment is brought to you by Narada Real Estate Investments, your premier source for cash flow investment properties. Visit turnkeyrealestateinvestments.com, turnkeyrealestateinvestments.com. Give my friend Marco Santarelli a call, and he can help you out with some passive properties for you to build out your portfolio. Again, thank you so much to Paul Jackson with Residential Capital Partners, and for him coming on the show and helping us understand their products and how we can leverage the capital that they have available to do more deals. And I hope that that's your strategy today as a real estate investor, as you come on the platform of Think Realty, that you're finding the education and the resources resources so that you can go out and do more deals, find more wealth, time, purpose, which are the pillars of Think Realty. So thank you guys so much for watching. I hope you'll continue. Join us on social. Start the conversation with us. Tell us the questions you want answered. Tell us the people you want us to interview, and we'll make that happen for you. Thank you so much. Have a great day.